Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
This is Coach T from Tackle Trading, and this is the morning mailbag. And the morning mailbag is my opportunity to come in and impart some of my wisdom and help you guys understand a topic and answer one of your questions. Essentially, if you know how to access me, Twitter, Facebook, email, or our clubhouse at Tackle Trading, you can send me a message or you can post it in one of our forums, and I will answer the best ones because I think it's going to help our entire team. And quite frankly, that's what we're here for. Go team, right? Absolutely. That's the whole point of Tackle Trading, is to bring traders together and help each other out. The question today and the topic today, I want you to write it down, is called covered call. And if you've never traded a covered call, we're going to give you a crash course on it, but we're going to get down to a part of the covered call that's going to help you understand how to execute the trade. One of the big challenges with books and picking up just a book on trading, or you can get a 4-inch thick book and it will tell you all the strategies, but it won't tell you how to manage the trade, which is the big challenge. And that's where a lot of traders have questions. This one comes from Ronald. And Ronald says, Tim, I was reviewing the third session and I'm confused about total cost and risk. As I understand that the total cost is 1, 5, or 20% for each trade, depending on your system. What about the risk? How do we calculate the risk? And on a covered call, do we have a stop and a target for the stock? A couple of different components of the question here, and I'm going to grab my highlighter and I want everybody to write down a few words. Cost, risk, okay, those are two things that we're going to define. And system, we're going to talk about that. Stop and target. In a trading system, every one of these things need to be defined. Now, covered calls are a strategy. A strategy is a type of trade where you build it to go out for, and put it on the market. A system is how you execute the strategy. And I think it's important that we kind of define the differences here before we get started too far down the rabbit hole. And the strategy is like owning the car. System is driving the car, right? So I can have a Ford truck. I got a Ford truck in my driveway. It's an Expedition, big old unit. Put my dogs and my kids, and we get up in the mountains and whatnot. But just owning the truck doesn't teach me how to turn the engine on, drive down the highway, find a place, make sure I navigate traffic and all that kind of stuff. Systems are more about how you execute and how you actually build the trade out once you're in the truck, right? And so there is a big difference, and systems are much more important. Anybody can learn a strategy, okay? Covered call is 100 shares and you sell a call. That's a strategy. A system is how to go out and make money with it. And so, and that is really the investor and trader mindset. When you decide on a certain strategy and that you want to take it into the system category, you got to make a commitment, get people around you, and definitely work on systems. Even if you just have one, that can help you, make sure that you're approaching the market in a smart way, with rules, without emotion, and that you know what to do on a daily basis. This is where processes come in, and rules. Rules. Set goals on developing those rules and make sure that you hold yourself accountable. And as always, one of the most important things you can do is track your progress by keeping track of it in a journal, whether that's through a back test or forward test or just paper trading, or you just write them down in an actual journal, anything, but you got to keep score. So let's talk about the covered call for just a moment. A covered call is an options and stock strategy that involves buying 100 shares, selling a call option, and that turns it into a covered call. Now, with this, there are several rules, right, that go into this. Generally, what we talk to students about and what we teach people how to use is the stock has to be a good stock with technicals and fundamentals. Guys, you have to like the company. Okay, now if you don't know how to evaluate that, that's a different class. That's a full class. This is just a morning mailbag question, answering one. But technicals are reading the chart, right? You have to like the chart. Fundamentals are looking at the numbers. The earnings, the debt, the revenue, the position the company is, the leadership, all that kind of stuff. Now, shorting a call, you have to have options, access, and privilege. If you're in a 401k, you don't. You need to have an IRA account with options privilege or some form of trading account, whether it's an individual account, cash account, margin account, anything that you've got access to options in. Now, usually, and there are a lot of different rules for this, but a good starter rule is 30 days and out of the money. Out of the money. And this turns it into the covered call, is what it is. So you have an obligation to deliver your stock at that strike price. That's what a covered call is. And in Ronald's class, he had learned the covered call, and now he's asking some questions about position sizing and risk. Covered call, we're looking for a neutral to bullish company, out of the money strike at 40 delta, and usually 1 or 2 months at a time is a good starter rule. And this is where, this was the exact rule that Ronald's talking about. The position size will say, according to personal preference, typically between 5 and 20%. So Ron, let me help you understand that. If you got $1 million and you put 200 grand into one stock, that's 20%. Okay? That's neither good or bad. It can't be defined that you have to do it or can't do it because we have to talk about what the company is. If you're putting 20% of your entire portfolio into one company, you better dang well like that company. You better know that company and should have researched that company. I'll give you an example of some people who've done something like this. Warren Buffett. Warren Buffett put a big stake of his company into just a few companies. Coca-Cola is one of them. And the reason Warren Buffett does that is because he knows Coca-Cola. Coca-Cola pays a dividend, and he's comfortable having an increased position size. But let's say that you put 200 grand into a small company, maybe a company that's just new to the market in the last 10 years, doesn't have an established track record, doesn't have established leadership, and you think that it's got big upside, but maybe it only has a few core products. Like, what if they... I don't know, they make shoes that are kind of meshy and they're flexible and you wear them to the beach, like a Crocs. You ever heard of a Crocs shoe? Well, that company's nearly out of business now. They may still be in business, but it used to be a $70 stock. Now, if it's a couple bucks, I'd be surprised. See, you have to know your company. You have to know what they do. You can't lever up on a really aggressive position size if you're not comfortable with understanding the risk. Now, that's management, and that's where selection comes in as well. So when we say 5 to 20% based on your personal rules, is you have to make the decision, quite frankly, is what it is, right? The expectation we're looking for, we want to get a 3% ROI if we're trading the covered call. If you're an investor and you've got a conservative stock, you might be willing to take 2% or even a 1.5% on a big Starbucks or Coca-Cola or Microsoft. This is where management comes in. As a trader, you have to make a decision. Am I doing this as a one-off trade? Do I like this just so that I can make money this month? Okay, that's where you're going to get aggressive with the covered call. Or do I want to own this company forever? Now, this is the difference between system and strategy. If you are buying a stock because you believe in the fundamentals and you believe in the long-term health and potential and growth of the company and you want to own it month over month over month over month over month over month, so that you can cash flow on it, that's an investor. You wouldn't set a stop loss and a target. But if you're trading it as a trader, and in your notes I want you to put down this, trader versus investor, okay? TVI. If you haven't made that decision yet, it will be very nearly impossible to develop your rules. Because these rules we're talking about are for traders. They are not for investors. Investors have different rules. A trader is going to put a stop and a target. Absolutely, you don't avoid it. A trader is going to go and execute an order much more efficiently. A trader is going to watch the day-to-day differently because you're managing both the stock and the call. See, an investor is mostly just managing the call, and the word we use is called rolling, okay? Rolling. If you've bought a stock as a core investment and you want to hold on to it, you simply roll the call option over and over and over and over again and you execute it differently. That's where the conservative management's going to come in. Now, the stop loss, usually you want to put it at your break-even point, maybe below a stop or support level if you are trading. You need to learn the risk graph as well if you're going to be a covered call trader. The management of a covered call. If you get into a trade and it goes neutral, you will have a profit, okay? If it goes down, you will lose money on the one-off trade. And if it goes up, you will make a profit. You'll have a profit. Watching your statement and learning how to read it is an important skill set. And I would recommend the Options 101 and 201 and Thinkorswim tutorials on the Tackle Trading YouTube channel. There are dozens and dozens of videos to help you with that. So we have to manage these. You know, we'll make money sometimes. We will lose money at times. And we will also kind of make money even if it goes nowhere. That's the beautiful thing about a covered call trade, is that it doesn't have to go up for you to generate a profit. You've built in the neutral expectation as well. In trading, it does come down to a couple of components: cost, effort, and risk. And one thing about trading a covered call as a strategy, the effort that you put into it, it should be fairly straightforward and minimal. I don't think it takes more than a few minutes to manage a covered call on a daily basis. I would also suggest that as a trader, you automate your orders by adding the stop loss and targets in there. Cost is how much you spend to get into the position. Again, 1, 5, or 20%, Ron. It does have to come back to your personal design and your personal rules, because you can spend 20% on a Coca-Cola, and this gets down to the real core of your question. You can spend 20% on Coca-Cola if the risk is only 1%. You have to evaluate that. See, cost is what you spend out of pocket. Risk is how much you'll lose if you're wrong. Those are different things, very different things, and it's an important thing to define. Cost is what you spend to make the transaction, to make the trade, and risk is what you lose if you are wrong. And you have to calculate that. So if we spend that 200 grand on $1 million portfolio, but our stop loss and our management and our expectation is that if we're wrong, we only lose 10 grand, well, then we lose 1%, right? You know. Let's bring those numbers down a little bit for a new trader that might be starting with a smaller account. Let's say you have a $10,000 portfolio. Well, you can put $2 grand into one stock, but your risk better only be $100. See, cost and risk are different things. So how much do you spend versus how much will you lose when you're wrong? That's what we're talking about with cost and risk. And the big rule is for risk. Generally, we talk 1%. Okay. The maximum risk you should ever take, and I don't care really if you have $1,000 or $1 million, you should never risk more than 4% of your portfolio on any one transaction, any one day in the market. That's risk of ruin theory, and that's an important concept. Remember, covered call, you have an asset, you buy the stock, and you're giving up the obligation to that stock. So one thing that you always can do is you can let it go till the expiration. Think about it like this, and one of the best ways to teach the covered call is to talk about it in terms of something that you probably already understand, like a house. You know, the asset in the stock market is a stock certificate. The obligation is the contract to give it up. Well, where does this relate to being in a home, renting a home, owning a home, things like that? Well, if you're the renter and you bought a lease option on a home, you got the contract and the rights to buy the stock. Okay. If you own the home and you give up the lease option, and what a lease option is essentially is just a call contract for a house. You're getting the rights to own the home later for a specific price. So let's say, Ron, I come down there to South Florida and I want to, rent your house and potentially maybe move into it. And I say, Ron, I'll give you $1 million, in a year if I want to buy it. And for the rights to own the home for a year, I'll give you 50 grand today, and we come up with a contract. Those are the rights and obligations. And so in your covered call, if you wait out the 30 days and the value of the stock has gone up, remember, they will take your stock. That's not a bad thing. Covered call traders need to remember that if the market takes their stock, it means you've made your maximum profit. In a risk profile, the maximum profit happens at expiration, at the strike price or above. It's when the stock has gone in the money and then you actually do deliver the stock. This has been another edition of our morning mailbag. You can find us pretty much anywhere you usually find people. Twitter, Facebook, Instagram, LinkedIn, Pinterest. But I'm going to give you even a better one. I want you to go and get in our clubhouse. In the comments section, I'm going to put in a link for our clubhouse. And that way you can meet people like Ron, and you can meet people like myself, and you can start to build a team and a network and, ask questions with each other, help each other out. Ron, probably the core takeaway here is that risk is different than cost, and that's where those percentages come in. You can spend 5 or 20%. You do your own calculation because the risk is determined based on the underlying stock itself. Some companies move faster, so you might have to, drop the percentage of what you spend down because you still need to control the risk. And really, if you control the risk, the cost is less important. As long as your risk is down where you're comfortable, based on your position size, that is the most important component of the trade in and of itself. Guys, tackletrading.com is a wonderful place to get in the game, learn how to trade, and I am out. Thank you very much. Coach T.